Commercial real estate underwriting is a critical evaluation process. It is performed before acquiring or financing a property. The core purpose is to assess the risks involved. It also aims to determine the potential financial return of the investment. Think of it as a thorough investigation of the property's financial health and future prospects. This due diligence is fundamental for any serious investor. It forms the backbone of a sound investment decision, ensuring you understand exactly what you're buying or lending against. This process helps to uncover hidden issues and validate the seller's claims, making it indispensable. The importance of underwriting for investors cannot be overstated. It empowers them to make informed, intelligent decisions. Rushing into a commercial property deal without proper underwriting is like navigating a ship in a storm without a compass. Thorough analysis helps prevent costly mistakes that could jeopardize significant capital. It provides a clear, data-backed understanding of the property's ability to generate cash flow. This understanding is the foundation for any successful long-term investment strategy in the commercial real estate sector. Without it, you are essentially gambling with your investment funds, hoping for the best outcome. Underwriting leads to several key outcomes, all vital for an investor. Primarily, it provides a clear and objective understanding of the property's current financial health. It scrutinizes income streams and operational expenses meticulously. Furthermore, it assesses the property's ability to generate consistent and predictable income over time. Understanding its position within the local market is another crucial outcome. Strong underwriting also supports the negotiation process by identifying areas of concern or overvaluation. Finally, a comprehensive underwriting package is essential when seeking financing from lenders, as it demonstrates the viability of the investment. This guide aims to provide you with a clear, step-by-step approach to commercial real estate underwriting. We will journey through the entire process together. We will start with the initial phase of gathering essential property data. Then we will move to analyzing rent rolls and constructing a detailed pro forma financial model. We will also delve into market analysis, capital expenditures, debt considerations, and return calculations. The goal is to equip you, the reader, with the foundational knowledge and practical skills required for effective underwriting. This will enable you to approach commercial real estate investments with greater confidence and analytical rigor. The very first step in the underwriting process is comprehensive property data collection. This stage is foundational. Without accurate data, your analysis will be flawed. You need to gather a specific list of essential documents. This includes the current rent roll, detailing all tenants and lease terms, obtain historical operating statements for at least the past 2 to 3 years. Profit and loss statements are also critical. Copies of all existing lease agreements are necessary for verification. Don't forget property tax bills, current insurance policies, details of service contracts, and a history of capital expenditures. This initial data forms the raw material for your entire analysis. Historical financial statements are incredibly revealing. They show the property's past performance trends over several years. You can identify patterns in both income generation and expense categories. For instance, you might see consistently rising utility costs or fluctuating vacancy rates. However, it is crucial not to take these historical figures at face value. Third-party verification is a key principle of prudent underwriting. Whenever possible, cross-reference the seller-provided data with independent sources. This could involve checking figures against bank statements, audited financial reports, or property tax records to ensure accuracy and reliability. This diligence helps catch errors or misrepresentations. Analyzing the rent roll is a critical task early in the process. The rent roll is a snapshot of the property's income from tenants. Key components include tenant names and their corresponding suite numbers. It lists the square footage each tenant occupies. Lease start dates and, importantly, lease expiration dates must be carefully noted. The current rent amount per tenant is listed, along with any security deposits held. Understanding the reimbursement structures, such as triple net, gross or modified gross leases, is vital as it affects who pays for operating expenses. Pay close attention to tenant concentration. Relying too heavily on 1 or 2 major tenants can be risky. Identifying potential red flags within the rent roll is essential for risk assessment. A high physical or economic vacancy rate is an obvious concern. Multiple leases expiring in the near term can signal future income instability and significant releasing costs. Scrutinize properties with many tenants paying rents significantly below current market rates, especially if lease terms prevent timely increases. Be wary of heavily discounted or abated rents offered to attract tenants, as these may not be sustainable. Finally, unverified tenant creditworthiness or a high proportion of struggling businesses can indicate a higher risk of default and future vacancies. A pro forma financial model is a cornerstone of commercial real estate underwriting. Essentially, it is a detailed, forward-looking financial projection for the property. Its primary purpose is to estimate the potential future income and expenses over a specified holding period, typically 5 to 10 years. This model is absolutely crucial for determining a property's potential investment value and the returns it might generate for investors. The projections within the pro forma are not guesses, they are based on carefully considered assumptions. These assumptions are derived from the current property data, historical performance, and prevailing market conditions, ensuring a realistic outlook. The pro forma model contains several key line items that build upon each other. It typically starts with potential gross income. Potential gross income represents the total rental income if the property were 100% occupied at market rents plus any other income sources. From potential gross income, you subtract an allowance for vacancy and credit loss to arrive at effective gross income. Next, you detail all operating expenses. These include items like property taxes, insurance, property management fees, utilities and repairs and maintenance. Subtracting total operating expenses from effective gross income yields the net operating income, a critical measure of profitability before debt service and capital expenditures. Let's consider a sample structure for building your pro forma. You begin by listing the scheduled base rental income from all current and anticipated leases. To this, you add any other income the property generates, such as fees from parking, laundry facilities, vending machines, or antenna leases. This total becomes your potential gross income. Then apply a vacancy allowance, a percentage based on market conditions and property history, to calculate the vacancy and credit loss. Subtracting this from potential gross income gives you the effective gross income. Below effective gross income, list each operating expense category clearly and sum them to get total operating expenses. Finally, effective gross income minus total operating expenses equals net operating income. Explaining and justifying your assumptions is paramount for a credible pro forma. Every input from rental rates to expense growth needs a solid basis. Vacancy rate assumptions should be supported by current market vacancy levels for similar properties and the specific property's historical vacancy. Projected rent growth must align with existing lease escalation clauses and anticipated market rent trends. Assumptions for operating expense growth should consider historical trends, inflation forecasts, and any known changes to service contracts or property taxes. Meticulously document all your assumptions within the model or in accompanying notes. This transparency is vital for anyone reviewing your analysis. A thorough market analysis is indispensable in commercial real estate underwriting. Understanding the specific submarket where the property is located is absolutely key. Your analysis should compare the subject property's potential performance against prevailing local market trends and conditions. Submarket vacancy rates are a critical indicator. They reflect the balance between supply and demand for that property type in that area. A low vacancy rate generally signifies a strong market for landlords, suggesting healthy demands and potentially supporting higher rental rates and quicker lease-up of empty spaces. Conversely, high vacancy rates indicate a softer market, demanding more conservative assumptions. Verifying rent comparables, commonly known as rent comps, is another vital step. This involves identifying several similar properties within the immediate geographic submarket. You need to analyze their current asking rents and, more importantly, the actual rents they have recently achieved for new leases or renewals. It is crucial to adjust these comparable rents for any significant differences between the comp and your subject property. Factors for adjustment include property age, condition, size, quality of construction, included amenities, and specific lease terms offered. This diligent process helps to validate or refine your pro forma rental income assumptions, ensuring they are grounded in market reality. Evaluating absorption rates provides further insight into market dynamics. The absorption rate measures how quickly vacant space is being leased up within a particular market or submarket over a defined period, such as quarterly or annually. A high positive net absorption rate is a very positive sign for investors and landlords. It suggests strong tenant demand for space, which can lead to decreasing vacancy rates and upward pressure on rental rates. Understanding the local absorption rate impacts your assumptions for how long it will take to fill any current vacancies or lease up newly developed or repositioned space in your property. Capital expenditure analysis is crucial because these are significant non-recurring investments required to maintain or improve a property's value and competitiveness. You must meticulously detail any immediate capital expenditure needs, such as urgent repairs to the roof or HVAC systems that cannot be postponed. Then list any deferred maintenance items. These are repairs or replacements that have been put off but will eventually need to be addressed to prevent further deterioration. Finally, and very importantly, you must budget for future capital needs. This includes allowances for tenant improvements when new tenants move in or existing tenants renew, and leasing commissions paid to brokers. These costs are typically below the net operating income line but significantly impact net cash flow to investors. Section 5. Financing and returns, debt modeling, and profitability metrics. Debt modeling is an essential component of most commercial real estate underwriting exercises because the vast majority of property acquisitions involve some form of financing. It is critical to understand typical lender terms and how they will impact the investment's cash flow and overall returns. Key terms include the loan amount, often expressed as a loan-to-value ratio, which is the loan amount divided by the property's appraised value or purchase price. You also need to know the interest rate, whether it's fixed for the loan term or variable based on an index. The amortization period determines how principal and interest are repaid over time, while the loan term specifies when the entire loan balance is due. Also account for any loan origination fees or points. Calculating the annual debt service is a fundamental part of debt modeling. Debt service represents the total amount of principal and interest payments the borrower will make on the loan over a one-year period. This is a major cash outflow that directly impacts the pre-tax cash flow available to equity investors. For simpler loans, you can use a standard mortgage payment calculation like the PMT function in Excel. For more complex debt structures, you might refer to detailed amortization schedules provided by lenders. A critical metric that lenders use to assess risk is the debt service coverage ratio. This is calculated as net operating income divided by annual debt service. Lenders typically require a debt service coverage ratio of 1.20 times or higher. Once you have projected cash flows after debt service, you can calculate key return metrics. One important measure is the equity multiple. The equity multiple shows the total cash distributions received by the investor throughout the entire hold period, including from sale proceeds, divided by the total equity initially invested. For example, if an investor puts in $1 million and receives a total of $2.5 million back over 5 years, the equity multiple is 2.5 times. It's a straightforward way to understand how many times you get your initial equity investment back, providing a simple gauge of overall investment profitability without considering the time value of money. Other vital return metrics provide a more nuanced view of profitability. The internal rate of return is a widely used metric in commercial real estate. The internal rate of return is the discount rate at which the net present value of all projected cash flows, both negative initial investment and positive future cash flows from operations and sale, equals zero. It represents the effective annualized rate of return on the investment. Another common metric is the cash-on-cash return. This is calculated as the annual pre-tax cash flow, net operating income minus debt service and capital expenditures, divided by the total equity invested. It measures the annual return on the actual cash put into the deal, providing a snapshot of current income yield. Section 6. Advanced Financial Document Scrutiny. A deeper dive into the rent roll can reveal critical insights beyond basic occupancy and rental income. Calculate the weighted average lease term, sometimes referred to as WALT or weighted average unexpired lease term. The WALT provides a measure of tenant stability and helps quantify the property's lease rollover risk. It is typically calculated by weighting each tenant's remaining lease term by their occupied square footage or their contribution to the total rental income. Also, carefully analyze any contractual rent escalations embedded in the leases. These could be fixed percentage increases annually, increases tied to the consumer price index, or other negotiated step-ups, all of which impact future income projections significantly. Analyzing historical and projected tenant improvement costs and leasing commissions is also crucial, often drawing information from the rent roll and lease abstracts. Correlate the tenant improvement allowances provided to tenants with the length of their lease terms and the type of space. Longer lease terms might justify higher initial tenant improvement packages, as the cost can be amortized over a greater period. Understand that significant future tenant improvement and leasing commission obligations, especially if many leases are expiring, can substantially reduce the net cash flows available for distribution to investors or for reinvestment into the property. Remember, these are capital costs, not operating expenses, and are deducted after net operating income but before arriving at pre-tax cash flow. Pro forma adjustments are often necessary to arrive at a stabilized net operating income. Stabilized net operating income represents the property's anticipated annual income-generating ability under normal, ongoing market conditions, typically after any initial lease-up period for new developments or significant repositioning efforts for existing assets. To calculate stabilized net operating income, you will adjust the historical operating statements to remove any non-recurring income or expense items or one-time events that are not expected to continue. You then apply your carefully researched, market-based assumptions for future vacancy rates, rental income, other income, and all categories of operating expenses to project a sustainable income level. Performing a sensitivity analysis is a critical step to understanding the robustness of your investment thesis. This involves systematically varying key assumptions within your pro forma model to observe their impact on important financial outcomes like net operating income, pre-tax cash flow, internal rate of return, and equity multiple. For instance, you might test scenarios such as, what if market rental rates achieve 10% less than projected? What if vacancy increases by 5%? How does a 50 basis point increase in the exit capitalization rate affect the projected sale price and overall returns? This stress testing helps quantify potential risks and identify which assumptions have the most significant impact on profitability, allowing for more informed decision-making. Section 7. Crafting the investor presentation. The primary purpose of an investor presentation, often called an investment memorandum or offering memorandum, is to clearly and concisely communicate the details of a commercial real estate investment opportunity. It should go beyond just numbers. It needs to tell a compelling story about the property. The presentation must highlight the property's inherent strengths, the sponsor's or investor's strategic plan to create or enhance value, and the potential financial returns. Ultimately, a well-crafted presentation aims to instill confidence in potential equity investors or lenders, persuading them that the investment is sound and aligns with their objectives. It is a critical marketing document for raising capital. The executive summary is arguably the most important section and should appear at the beginning of the presentation. It needs to grab the reader's attention immediately. Start with the fundamental details. Clearly state the property type, the specific location, the proposed purchase price, and the total capitalization, which includes acquisition and immediate capital improvements. Crucially, the executive summary must clearly articulate the target investment hold period, typically expressed in years, such as 5 to 7 years. It should also prominently feature the projected investor returns, such as the target internal rate of return and the anticipated equity multiple. Following the executive summary, A financial highlights section should provide a snapshot of the investment's key financial metrics. It is effective to showcase both current, in-place metrics and projected pro forma figures. For example, list the current occupancy rate, the in-place net operating income, and perhaps the current capitalization rate based on the purchase price. Then present the key pro forma metrics that result from your underwriting. This includes the projected stabilized net operating income, the anticipated year-one cash-on-cash return, and the average annual return over the whole period. Using clear charts, graphs, and tables in this section can greatly enhance understanding of the financial projections and the expected financial improvement over time. To complete the narrative, your presentation must detail the value creation plan, address potential risks, and outline the exit strategy. The value creation plan should describe the specific repositioning strategies, such as property renovations or upgrading common areas. Operational improvements like professionalizing management or reducing expenses, or leasing strategies such as targeting specific tenant types or aggressive lease-up of vacant space. A risk matrix should identify key potential risks like market downturns, tenant defaults, operational challenges, or rising interest rates, and outline the specific mitigation strategies for each. Finally, clearly describe the planned exit strategy, including the target sale price, assumptions about the exit capitalization rate, and perhaps alternative exit options. Section 8. Essential Toolkit and Proven Strategies. When it comes to underwriting software, Microsoft Excel remains a cornerstone for most analysts, especially for creating detailed and customized financial models. Its flexibility allows for tailored analysis specific to any deal. For more complex properties, particularly those with intricate lease structures or multiple tenants, specialized commercial real estate software like Argus Enterprise is an industry standard, widely used by institutional investors and appraisers. In recent years, various newer cloud-based platforms have also emerged, offering streamlined underwriting capabilities, data integration, and enhanced collaboration features for teams. The choice of software often depends on the complexity of the deal and the resources of the analyst or firm. Access to reliable market data is absolutely crucial for developing accurate and defensible assumptions in your underwriting. Leading national providers like CoStar and Rice offer comprehensive databases covering property details, market trends, rental comparables, sales comparables, and current vacancy and absorption rates across various markets and property types. These services are subscription-based and can be expensive, but the depth of data is invaluable. Additionally, local brokerage firms often publish market reports that can provide excellent insights into specific sub-markets. Don't overlook publicly available data from government economic development agencies or local planning departments, which can also offer valuable context. Effectively presenting complex financial data and market analysis is a key skill. Microsoft PowerPoint is the standard tool for creating investor presentations and pitch decks. Charts and graphs generated in Excel can be easily embedded into PowerPoint slides to visually represent trends, financial projections, and comparisons. For analysts or firms looking to create more dynamic and interactive data visualizations, software like Tableau or Microsoft Power BI can be very powerful. These tools allow for the creation of dashboards and interactive reports that can help investors explore the data more deeply. The goal is always clarity and ease of understanding for your audience. Several proven strategies or pro tips can significantly enhance the quality of your underwriting. Adhere to the principle of trust but verify. Always critically examine and attempt to independently verify any data provided by sellers or brokers. Dig deep into historical operating expenses, look for unusual patterns or items that might be non-recurring. Make sure you understand the nuances of every significant lease clause, not just the rent and term. Whenever possible, walk the property thoroughly yourself, ideally with knowledgeable colleagues. This physical inspection can reveal issues or opportunities not apparent in financial statements, rent rolls, or photographs. Finally, maintaining conservative assumptions in your projections is generally a prudent approach. Section 9. Conclusion. Mastering the art of underwriting. To recap, commercial real estate underwriting plays an absolutely central role in the world of property investment. It serves as the bedrock upon which prudent and successful investment decisions are built. This systematic process allows investors and lenders to thoroughly evaluate both the potential risks and the prospective rewards associated with a particular commercial property. By diligently applying underwriting principles, investors are empowered to make sound, data-driven decisions. This methodical approach helps to move beyond mere gut feelings or prevailing market hype, grounding choices in verifiable facts and careful projections, which is essential for long-term success in this competitive field. This guide has aimed to walk you through the key takeaways of the underwriting journey. We have emphasized the critical importance of adopting a methodical and structured process. This begins with diligent and comprehensive data gathering, ensuring all necessary documents are obtained and reviewed. It proceeds through meticulous rent roll analysis to understand current income and tenant risk. Then, it involves building a robust and well-supported pro forma financial model to project future performance. Stress testing those assumptions through sensitivity analysis is also vital. Each step methodically builds upon the previous one, culminating in a complete and insightful picture of the investment opportunity. Reiterating some of the most important best practices is worthwhile. Diligence, an unwavering attention to detail, and a healthy dose of conservatism in your assumptions are paramount characteristics of a skilled underwriter. The commercial real estate market is dynamic, so you must continuously seek out and refine your assumptions with the latest market information and trends. Always strive to understand the story that lies behind the numbers. Don't just crunch figures without grasping their real-world implications. Perhaps most importantly, commit to never stop learning and adapting your analytical techniques as the market and best practices evolve over time. Finally, remember that mastering the art and science of commercial real estate underwriting is an ongoing journey, not a destination. The experience gained from each deal you analyze, whether it ultimately proves to be a successful investment or a learning opportunity, will progressively hone your skills and sharpen your judgment. The principles and steps discussed throughout this guide provide a solid and reliable foundation. They are designed to help you navigate the inherent complexities of commercial real estate investment with greater confidence and analytical prowess, ultimately positioning you for achieving your long-term financial goals in this rewarding sector.